Now what? That's the question investors are muttering to themselves as they stand on the precipice of the second half of 2018. And who could blame them? Many of the catalysts that have been fueling the aging bull market are fading, and a growing list of investor concerns and some puzzling relationships have taken their place. As January's market melt-up headlines get more distant in the rearview mirror, the road ahead may be littered with tighter monetary policy, rising interest rates, building inflationary pressures, fragile trade negotiations, and geopolitical flare-ups. Simultaneously, and perhaps unluckily, global synchronized growth, which was so instrumental in boosting asset prices in the last year, is dwindling. Massive U.S. fiscal policy has so far failed to materially change the growth trajectory, and corporate profits likely peaked in the first quarter. Not surprisingly, with very few identifiable catalysts to drive risk assets higher, most assets have treaded water in the first half of 2018.
Ironically, in such a holding pattern, Q1's peak corporate profits grabbed headlines. Q1 marked the highest earnings growth since Q3 of 2010, and the fourth time in the past 5 quarters that the index has reported double-digit earnings growth. Plus, 78% of companies beat expectations, the highest figure on record and by the widest margin since Q4 of 2010. However, this may be as good as it gets. Q1 is projected to be the high watermark for the year. Earnings growth has been revised lower for 10 out of 11 GIC sectors for 2019, as well as for regions outside the U.S. Looking back, we'll view Q1 2018 earnings season like the Beatles' Sgt. Pepper's Lonely Hearts Club Band album, full of hits, hard to replicate, and not fully appreciated until well beyond its time. Crossing this peak into the second half of 2018, we'll see a market without an improving fundamental backdrop, leading to uneven price performance, increasing dispersion, and more opportunities for tactical asset allocation. And with growth becoming challenging, investors may want to tilt towards areas of the market with the highest earnings growth potential.
No question, investors have plenty to adjust to. The environment is shifting. For the first time in the post-global financial crisis era, the 2-year Treasury yield is more than 30% greater than the S&P 500 index dividend yield. Add that to modest year-to-date stock returns, falling bond prices, growing risks in the post-peak everything environment, increased volatility, and an elderly bull market. Suddenly, the "there is no alternative to equities" narrative has for the first time in a long time increased competition for investors' capital for short-term, conservative, and sometimes risk-free investments. Complicating matters further is that with rates finally rising instead of precipitously falling, traditional bond allocations may not provide investors a good hedge against risks to their stock portfolios. This challenge comes at a time when traditional defensive stock investments like utilities, consumer staples, telecom, and REITs have also failed to support portfolios. These often highly indebted sectors were used heavily by investors as income substitutes in the TINA environment. Defensive sectors have doubly suffered from concerns that rising rates would negatively impact these companies' debt loads, while investors now have better choices to generate income.
Another adjustment is that the market has blown past peak synchronized global growth. Less coordination will likely equal less growth, but more acrimony between countries. With greater protectionism, investors may want to focus more domestically to remove sensitivity to trade-related conflicts, something large multinationals are generally more affected by. This means tilting more towards small caps, both in the U.S. and internationally.
I'd add that global cyclicals are likely to continue to outpace defensive investments in the second half of 2018. And finally, let's highlight the positives. Global synchronized growth and corporate profits may have peaked in the first quarter, but they are still positive. After more than a decade of easy monetary policy, conditions may be tightening, but they are doing so gradually. Interest rates and inflation are rising, but both remain well below previous historical highs. We may be past peak, but the current climate still suggests there is time in this seemingly ageless business cycle and bull market.